Good morning, everyone. Jen Tozer, your portfolio manager here. I hope you're having a lovely fall. I definitely have been having a good fall, and what's been great is we've been doing lots of travel, but also working on the topics, the content for our seminar that we're going to have in January. So to hold on for more news about that later. What I wanted to talk to everyone about today is the current market volatility. I've had a couple of questions about it because let's talk about it. You know, the market's down, tech stocks are down, bond yields are down because people have been buying bonds, gold is up, and even crypto, which is a general indicator of market sentiment, is down about 20%. So the question is, are we rotating right now from a bull market to a bear market, and do we have to be worried about a crash? Take a look at it. Some very famous people, specifically Michael Burry, has come out and said, hey, I'm shorting $1.1 billion of NVIDIA and Palantir. So let's talk about that for a minute. And I'm going to talk about what shorting means. So shorting means that you sell the stock, and when the price falls, you buy it back. And that's how you make money. And why is it important that Michael Burry made this statement? How come it's affected the stock? It's because he has a lot of credibility in the media. People know who he is because he was the guy in The Big Short who actually turned around and made about $800 million for his investors back in 2008 and 2009, when most people really had a lot of issues in their portfolio. But let's fast forward a minute to today, and let's talk about this trade that he's actually made. So he currently manages roughly $1.4 billion, and that's from SEC filings that were just filed. And he's shorting $1.1 billion. That's about an 80% portfolio move. And when you do something like that, you know what I do. I do tiny little moves, never to create major sways in your portfolio. He's done what we would call taking a bet. So he's done that. That's point number one. Point number two is, let's talk about how much it costs to actually do this. It costs your credit cost, which is roughly 8%, plus another 50 basis points because you're borrowing the stock from somebody else. Plus you have to pay the dividend to the owner of the stock. That's negligible in this case, but let's say his costs are running at about 8.5%. So if the trend doesn't work in his favor, he is going to have to close this out pretty quick. It's not something that you can just keep for a long period of time. And the third thing I want to talk about is about Michael Burry, and I mentioned this before just on one-on-one conversations, is if you take a look at how much money he managed back in 2008, and you take a look at where he is today, which is at this 1.4 billion, that's a compound rate of return over 17 years of roughly 3%. So if he didn't have his movie fame, he wouldn't have his stock market influence. And because he has stock market influence, in the short term, he is going to probably make money on his trade if he closes it out. But what it does not mean is that these companies that have had good returns are all of a sudden going to have the bottoms fall out. So that's my little note for today. I hope you found it helpful. You probably won't see it until Monday, but as always, give us a call if you have any questions.